Think you're too young to invest? Or maybe you feel like it's too late to start? Here's the truth. If you don't understand asset classes, your portfolio might end up looking like a confused shopping cart, random stuff thrown together with no game plan. In this video, I'll break down the 7 major asset classes, what they are, how they perform, and which ones make sense for you based on your age and goals. We'll even show you how a balanced portfolio can grow over decades if you just stick with it. If you're trying to make your money grow, but don't want to get a finance degree to do it, hit subscribe. We simplify money stuff every week. No suits, no fluff, just straight talk, strategy, and a sprinkle of sarcasm. Let's start with the basics. What the heck is an asset class? It's basically a group of investments that behave in a similar way. Think of them like dating types. Stocks, high growth, high drama. Bonds, reliable, shows up on time, texts back. Real estate, solid, but takes forever to commit. And crypto, well, crypto is texting 3 other investors at the same time while sending rocket emojis. Each asset class has its own risk profile, return potential, and personality. That's why building your portfolio with a mix of asset classes is how you grow wealth over time, without betting the farm on one bad date. Let's kick things off with equities, also known as stocks. When you buy a stock, you're buying a tiny slice of a company, like Apple, Amazon, or your favorite energy drink startup. Stocks can return 7 to 10% annually if you zoom out long enough. But in the short term, they're moody. One bad earnings call and boom, your portfolio takes a nosedive faster than your motivation on Monday. Still, they're the go-to for long-term growth, and every serious portfolio has some skin in the stock market game. Next up, bonds. These are like you lending money to the government or a company. In return, they pay you interest over time. The returns? Around 2 to 5% a year. Not exciting, but solid. Bonds are the responsible adult in your portfolio. They meal prep, sleep 8 hours, and probably journal every morning. When the market crashes and stocks are losing their minds, bonds are usually the chill voice saying, "We'll get through this." They may not make you rich overnight, but they help protect your wealth when the roller coaster gets too wild. Now we've got the emergency exits of investing, cash equivalents. Think treasury bills, certificates of deposit, and money market funds. These are ultra safe. They're so low risk, they barely move. Returns? 1 to 2% on a good day. Basically, they're the grandma of your portfolio. But during market meltdowns, cash equivalents are the ones calmly sipping tea while everything else burns. They won't make you rich, but they'll help you sleep at night, and they're perfect for your emergency fund. Real estate, the asset you can actually touch. We're talking houses, rental units, land, commercial spaces. It builds wealth in 2 ways: monthly income from rent and price appreciation over time. Returns can be anywhere from 6 to 10% annually, depending on the location and the market. Not bad, right? But real estate comes with strings. It's expensive, it's not liquid, and it's a pain to manage unless you go through REITs, real estate investment trusts. Still, it's a strong long-term play. A solid foundation, literally. Gold, oil, wheat, commodities are real, tangible goods that people trade on a global scale. They don't generate income like rent or dividends, but they do protect you when inflation goes full villain mode. Average returns around 2 to 5% per year. They're useful, but volatile. One geopolitical crisis and oil prices spike. One supply chain hiccup and wheat prices skyrocket. Commodities are like that blunt family member who tells it like it is, whether you're ready or not. Okay, let's get a little nerdy. Derivatives. These are contracts that derive their value from another asset, like a stock, bond, or commodity. Options, futures, swaps. This is finance inception. With derivatives, you can make a lot of money. You can also lose it before breakfast. They're complex, risky, and not for beginners. But if you're experienced or just love spreadsheets and adrenaline, this might be your playground. Otherwise, feel free to leave this one to the hedge funds. Ah yes, crypto. Bitcoin, Ethereum, Solana, Dogecoin if you're feeling spicy. Crypto is built on blockchain tech and is probably the most hyped and misunderstood asset class today. Yes, it can go up 100% in a year. It can also crash 70% by lunch. Think of crypto as that exciting date who's texting 3 other investors right now while sending rocket emojis. It's fast, flashy, and unpredictable. Rule of thumb: if you're under 30, it's okay to keep 5 to 10% of your portfolio in crypto, max. And as you get older, that number should shrink fast. Crypto is not where your retirement lives. It's where your risk lives. All right, quick recap on risk versus return. Stocks, 7 to 10% annually, volatile but rewarding. Bonds, 2 to 5%, stable and predictable. Cash equivalents, 1 to 2%, safety net. Real estate, 6 to 10%, solid but illiquid. Commodities, 2 to 5%, hedge against inflation. Derivatives, wild range, could be plus 50% or minus 100% in days. Crypto, anywhere from moon to crater. High upside, high chaos. Each one serves a purpose. The magic happens when you combine them strategically. Now let's build your portfolio age by age, because your 25-year-old self and your 55-year-old self probably don't want the same roller coaster ride. If you're in your 20s, you've got time. Take risks. Here's a sample allocation. 60% stocks, 10% real estate, 10% bonds, 5% commodities, 5% crypto, 10% cash or money market. Crypto is spicy. Keep it to 5 to 10% max. You're building a base here, not chasing memes. If you're in your 30s, still time to grow, but you might have responsibilities now, like kids, mortgages, or therapy. Here's a tweak. 50% stocks, 15% bonds, 10% real estate, 5% crypto, 10% commodities, 10% cash. This is growth with guardrails. If you're in your 40s or 50s, now it's about protecting what you've built. Crypto, nearly gone. Bonds and real estate take the lead. Sample mix: 35% stocks, 35% bonds, 15% real estate, 10% commodities, 5% cash. Crypto, optional at best, 1 to 2% if you must. So what happens if you stick to a balanced portfolio and stay consistent? Starting in your 20s, with $500 a month, over 30 years at 8% average return, you'll have around $680,000. Double that if you increase your contributions later. Starting in your 30s, same $500 a month, after 20 years, you'll have about $295,000. Still solid, but you missed a decade of compounding. Starting in your 40s with just 10 years left, at the same rate, you're looking at around $91,000. Still worth it, but much harder to grow without taking major risks. Time and consistency beat trying to time the market. Start early, stay steady, rebalance as you go. If this helped you, make sure to subscribe, because in part 2, we're going deeper. How inflation, interest rates, and recessions affect your portfolio. How to rebalance as you age. How to make your investments tax smart. And why checking your portfolio every day is a terrible idea. So hit subscribe, drop a like if you learned something, and stay tuned. Your next step to smarter investing is coming next week.